thank you all very much for joining me today. The goal is to tackle a wide range of topics. We're now 1 month into 2024, so some of the events perhaps that I was planning to discuss have already changed, and it's changing daily. We're in a very volatile environment. Walter's abstained. Now, Walter, I know why, because you don't take top-down macro views, but doesn't it have an impact on the way you assess the prospects for an individual security?
No.
Okay.
No. If you've got a 10-year time horizon and you want to hold the asset for 10 years, whether it's one cut or two cuts, it's not going to make a difference to the value of the asset. And because you're building a lot of safety in your thinking, it takes care of all the unknowns. So it's something that's worked for me, not to try and call those things. And past experience has shown that it's very hard to do.
Okay, thank you.
It's changed because I'm usually the opposite. I'm the one that always says they're not going to cut a lot. I think they do have room to cut. I think so. The question is, I mean, as Walter says, it's not easy to forecast a 12-month period, and you shouldn't be basing too much on a 12-month period. Because at the end of the day, if the economy stays strong for longer, they're not going to do the 4 to 5 cuts. But if you do start seeing the slowing, so what I think will happen is as you head to the second half of the year, the Fed will now have the ability to start cutting, because right now he's staying pat and staying very strong, Powell, and he's saying, I don't need to do anything because the economy is so strong, so I'm going to stand my kind of position and talk very strong to kind of keep the economy on its toes. As soon as you see some weakness, and this is kind of what I think will happen mid-year, you'll start seeing him start cutting immediately that he sees the slowing, because you'll have 2.5% inflation potentially, and he can cut rates to, remember, this 4 to 5, 25 basis point cuts is only 1 to 1.25% cut from the 5.2. So it's not like I'm predicting some sort of crazy number. I'm predicting 4%. The forward futures is, as I said at my talk, probably close on 2% cut. So actually, I've probably got a much less aggressive stance than the Fed and what the market's saying. So that's why I laugh, because I'm the most aggressive here, but actually right here down, I thought I might have been the least aggressive. Okay. So that's what makes markets, right?
All right. Yes, exactly. Thank you. And have you guys been colluding? No. Yes, I think there's a bit of consensus there. Lara, I'll come to you then next. So your view on where we'll end at the year, and maybe when we'll start cutting then?
Look, there are always a lot of moving parts to this. So again, you don't really want to be constructing portfolios on macro forecasts. But if I kind of had to say how I see it right now, it looks likely that it'll probably start about mid-year. I think that the market is pricing the number of cuts too aggressively. And the reason we say that is because you're still seeing huge economic activity coming out of the US, and you see, yes, inflation's coming down, but core inflation is 3.9%. It is still very high. And on top of that, I think that the amount of inflationary pressure coming from the fiscal side in the US is going to keep putting pressure on that inflationary number. So yes, they will start cutting because they will see that number coming down, but whether they can cut aggressively because of, let's say, that amount that it comes down, probably I think there's a high chance that it might not be enough. So they might have to trade a bit more cautiously with the cutting cycle than what the market thinks.
How have you positioned with the so what in mind? Which asset classes are you favouring or bearing in mind what the future may hold?
So I think one of the key points is why the Fed cuts, and you have two scenarios there. If the economy continues to pump along very generously, there will be no reason to cut at all, and that would be closer to your scenario. However, if the economy starts to slow down, which we also anticipate it might happen towards the second half of the year, then we will start to see some gradual cutting. We don't believe that it can be huge because services inflation is still at 5%. Where does this leave us in our portfolios? Well, we feel that at these rates, and these real rates, and with the current PEs on the S&P 500, we believe US equity is not offering great value. However, we do feel that there are selected opportunities in fixed income globally, especially on the fixed income we're finding in our portfolios, where we're finding yields of about 7% in hard currencies at very low duration. So that gives us
So what type of assets would there be? 7%?
credit.
What
a
would the
credit.
companies?
Credit, AT1,
Okay.
some banks, some dollar-denominated ABSs, but yeah.
Okay.
And those are the opportunities we're finding there. On the SA bond side, we think that we're probably more at fair value. We've had a great run from the CDS spreads coming in. We think that the risk is probably a bit to the upside. We think you'll probably clip the coupon at the moment at about 11%. And then on SA equities, we feel that there are some compelling stocks, but it is very much a stock picking environment.
Okay, thank you, Nicole. And Omri, if there are there any other different areas that you think a rate cutting cycle will favour that you're featuring in your portfolio?
Yeah, I think good arguments have been made that rates could stay higher for longer. And running a multi-asset portfolio, I think the benefit of that is that it offers you attractive risk-free returns at short duration, like Nicole said. So,
Just before you move on, can you explain when we say higher for longer? What does that mean? Are we talking 3 to 4%, or something more than that?
Yeah, I think the sort of 4%, 3 to 4, and 4% plus range.
Okay.
Which is an area that the market's not used to.
And the reason why I push you on that is
Yeah.
because it's higher for longer. Compared to the long-term history,
It's not high.
It's not high.
No, but I mean, when we're used to inflation of 2 or below, then 4% is quite high, and that's the point Lara also made. Is are we going to see those low inflation numbers? So whereas your fixed interest global or developed market fixed interest markets was an uninvestable asset class, suddenly that part of your universe that you can invest in has opened up again. So the low rates crowded all investments into risk assets and long duration assets. And I mean, it also determines the cost of capital. So you had a very low cost of capital, which sometimes result in very inefficient allocation of capital. It also drives sort of investors into the growth assets. If you look at how growth has outperformed value, that's been one of the big drivers. Now with rates where they are, and the market anticipating quite a fast cutting cycle, like Nick said, if it doesn't come through, one has to question, is the S&P at sort of its all-time highs appropriately valued if the cost of capital remains high? You've got very high debt levels globally and high rates. You have to service that debt at then much higher interest rates. So we don't think it's a completely risk-free environment at the moment where you can just put your whole portfolio into risk assets, and you don't have to because your less risky asset classes are offering you decent yield now, so you can build a nicely diversified portfolio, get a decent yield at sort of appropriate risk levels.